Imagine finding a hidden gem in the Indian stock market. An opportunity to own a piece of India's prominent companies, not at their market prices, but at a deep, deep discount. Sounds a little too good to be true, doesn't it? Well, for decades, a unique breed of companies in India have offered precisely this kind of a proposition to investors, the holding company. We're talking about discounts that can be as high as 70, 80, or even 90%. Think about that for just a moment, right? It's like buying a portfolio of stocks for 20 paisa on the rupee. For instance, in 2021, you could have bought Bajaj Holdings. They're the key entity of the Bajaj Group at a roughly 65% discount to the value of its stakes in Bajaj Auto and Bajaj Finserv. Or imagine smaller companies like Kalyani Investments and Summit Securities, which were trading at nearly 88% discount to their net asset values. This isn't a quirky anomaly. It represents a substantial margin of safety for investors, a built-in cushion that can lead to outsized returns. And all this isn't just theoretical. Now, a 2021 study by HDFC Securities that was examining 18 Indian holding companies showed that a remarkable 14 of them outperformed the Nifty index over 5 to 10-year periods, with 9 of them delivering 20% annualized returns in the decade leading up to 2022. Welcome to Bottom Line by Groww. In today's episode, we'll demystify Indian holding companies, how they work, how their valuations differ from their operating businesses, and how to possibly spot and profit from a holding company discounts using NAV and SOTP. First, let's lay the groundwork, right? What exactly is a holding company in the Indian context? Now, unlike the manufacturing giants or the service providers that we usually encounter, holding companies are the corporations whose primary job is to hold significant stakes in other companies. These folks aren't in the business of running day-to-day operations themselves. Or rather, what they do is that they serve as investment vehicles for these big business families or large conglomerates. So think of them as the backbone, really. They are consolidating ownership across multiple ventures for groups like Tata, Bajaj, or the Birlas. Here's an example. Bajaj Holdings and Investment Limited owns strategic stakes of 36.67% in Bajaj Auto and 41.53% in Bajaj Finserv, along other group investments like Maharashtra Scooters, Bajaj Electricals, Mukund, and Hercules Hoists. Others also include Summit Securities. They're representing the RPG Group and they hold major positions in CEAT, 31.6%, KEC International, 10.58%, and Zensar Technologies, 19.5%. Take Bombay Burma Trading Corporation. They maintain control of consumer giants Britannia Industries with a 50.5% stake. JSW Holdings. They primarily focus on JSW Steel with approximately 7.4% direct ownership. Pilani Investments and Industries. The Birla family's holding vehicle that maintains positions in Grasim Industries, 3.8%, and Ultratech Cement, 1.5%. What this structure does, it allows promoters to maintain control across a vast empire of diverse businesses through a single central corporate entity. For example, in FY25, Bajaj Holdings and Investment Limited's consolidated income was driven by its associates, with 88% coming from profit share in companies like Bajaj Auto and Bajaj Finserv, while only 11.93% came from other income sources such as dividends, interest, and rentals. Now, given this very unique financial role, they're typically registered as an NBFC, a non-banking financial company, and they're often specifically categorized as core investment companies under RBI guidelines. But this distinct structure requires a different kind of a lens for financial analysis. As traditional operating company metrics, they often misrepresent the true value of Indian holding companies. So let's explore specific valuation approach. The first one, sum of parts. The SOTP valuation. The most direct way to value a holding company is the sum of parts method. Your total market value of all the investment, add any net assets, and compare this with the intrinsic value of the company's market capitalization. The gap is the holding company discount. For example, as of August 11th this year, 2025, Bajaj Holdings and Investment Limited had a market capitalization of 1,52,329 crore rupees. Its 36.67% stake in Bajaj Auto was worth about 84,739 crore rupees, and its 41.53% stake in Bajaj Finserv was about 1,27,591 crores, a combined value of roughly 2.12 lakh crores. Compared to its market cap, this implies a holding company discount of 28.3%. The next metric, price to earnings ratio. Now, the traditional PE ratio can be misleading for holding companies. Many of them show very high PEs, not because they're overvalued, but because they reported profits that only include dividends, interest, or realized gains excluding unrealized gains from appreciating holdings. For example, right, in March this year in 2025, Tata Investment Corporation had a PE of 95.5 as it earned a profit after tax of just 312 crore rupees in FY25, which excluded other comprehensive incomes which stood at 955 crore rupees. In contrast, Bombay Burma Trading consolidates Britannia's financials since it owns 50.5%. So Bombay Burma's FY25 consolidated net profit was 2,200 crores, largely reflecting Britannia Biscuits business. This makes Bombay Burma's PE ratio look low at 5.6. But you must remember that those earnings mostly belong to Britannia's operations and not any action by Bombay Burma themselves. Now the key here is to look beyond reported EPS and focus instead on underlying asset values and earnings power to their portfolio. The third one, the price to book ratio. The book value myth. Now, the price to book ratio, which compares a company's share price to its book value per share, also tells you a unique story for holding companies. Many pure holding companies often sport minuscule PB ratios, which figures as low as 0.2 or 0.3 times for entities like Summit Securities, Kalyani Investment Company, and Pilani Investment. This indicates that their share prices are far below the accounting book value of their equity. This phenomenon is often known as the book value myth for holding companies. Historically, many holding companies carried their investment on their balance sheets at their original cost or at very conservative valuations. Now, this accounting practice meant that their reported book value significantly understated the true market worth of their holdings. So, this book value myth plays out vividly in the case of Kama Holdings. On paper, FY25 book value is based largely on the historical cost of acquiring their stake in SRF, which dramatically understates its true worth. Now, using the reported equity figure for its balance sheet, Kama's cost-based PB ratio comes at a lofty 11.27x, seemingly expensive at first glance. But when we replace SRF's book value with its current market value, that picture changes completely. The adjusted equity shoots up from just 850 crores to nearly 43,000 crores, and the PB ratio collapses to 0.22x. In other words, the market is valuing Kama at barely 22% of their fair value of holdings, at an almost 78% discount. SRF's market cap was 84,813 crores as of August 8th this year in 2025, and the stake held at Kama, 50.21%. That translates to 42,567 crore. The adjusted book, which is reported equity minus SRF at cost and adding SRF at market value, throws it to 42,988 crore rupees. Now, this clearly illustrates that a low PB value in a holding company doesn't necessarily signify poor asset quality or inefficiency. Instead, it frequently points to a hidden value that accounting practices have not fully captured. Next, market capitalization comparison. Now, a direct comparison of a holding company's market capitalization against the market value of its significant holdings immediately reveals the extreme disparity in pricing. Let's take Pilani Investment and Industries Corporation. Now, its total investment portfolio was valued at 16,481 crores as of FY25, while the company's market capitalization as of August 12th this year stood at just 5,400 crores. Now, this significant disparity means that the company is trading at an approximately 67% discount. Similarly, JSW Holdings, with its consolidated investment portfolio valued at 34,045 crores, while the company's market cap as of August 12th this year in 2025 stood at 19,858 crores. This substantial disparity means that the company is trading at an approximately 42% to its net asset value. Now, these vast gaps emphasize the latent value inherent in holding companies, which is simply not reflected in their direct market price. Now, while holding companies present compelling opportunities, investing in them comes with a unique set of risks and challenges that you as investors must navigate. The first one, perpetual or widening discount. The most prominent risk is that the holding company discount, no matter how extreme, may persist indefinitely or even widen further, preventing investors from ever realizing the true underlying value. Now, a stock can effectively become a value trap if the market never re-rates it. These stocks often have low trading volumes, making it difficult for large investors to influence prices, and low liquidity itself can justify a discount. The presence of high promoter holdings also leaves a limited public float, contributing to illiquidity. The bottom line is that the discount may never fully close and can at times worsen, necessitating significant patience from investors. Corporate governance and management decisions. A significant concern with holding companies is that they can be opaque with their corporate governance. They may engage in related party transactions or allocate cash flows in ways that minority investors may not favor. For example, a holding company may extend loans to promoters or other group entities on preferential terms, or it might support struggling sister companies by acquiring their shares, effectively allocating capital to weaker parts of the conglomerate. These actions can lead to value erosion. Complex cross-holdings within a group can also further entrench control at the expense of efficiency. Now, investors often fear value leakage, where resources are siphoned off through high managerial remuneration or unnecessary overhead or internal bailouts. Furthermore, given their often low public shareholding, controlling families can easily pass resolutions that may not be aligned with minority interests. Regulatory and tax change. Now, the holding company structure is susceptible to changes in government policy regarding taxation and regulations. Let's take an example here. The call auction mechanism announced by SEBI in June last year in 2024 represented a significant regulatory risk for holding company investors. While it was designed to enable fair price discovery, this intervention could substantially compress the extreme discounts that have historically provided attractive entry opportunities. Also, the implementation uncertainty creates unpredictable market dynamics. The timing, the efficiency, and effectiveness of these auctions can remain unclear, potentially introducing new volatility patterns that could disadvantage existing shareholders. Well, despite these risks, holding companies present enticing opportunities for value-oriented and patient investors. Long-term value investing. This is the classic, most fundamental approach. Now, the strategy involves buying holding companies when their discounts are at a historically high level and their underlying fundamentals are solid and growing. The investor then patiently waits for the inevitable mean reversion of the discount. And empirical evidence supports this. Whenever some holding companies have hit extreme discounts, the subsequent years have often seen significant outperformance relative to their underlying stocks. As an investor, you should continuously monitor the holding company's discount range over time. JSW Holding Limited exemplifies this pattern. Trading at a 71% discount in November 2021, it subsequently surged 327%, while its underlying JSW Steel Limited gained only 63.45%, demonstrating how extreme discount can create significant outperformance opportunities. Now, as such, two crucial prerequisites for selecting a holding company are: first, the prevailing discount must be historically high, and second, the underlying portfolio companies must be fundamentally stable and exhibiting growth. If both these conditions are met, the probability of a positive outcome dramatically improves. Investing via holding companies for thematic or group exposure. Some investors strategically use holding companies as a low-cost entry point into a particular business group or an overarching theme. For example, an investor bullish on the long-term prospects of the Tata Group could acquire shares in Tata Investment Corporation. Now, this provides exposure to a diversified basket of Tata companies that includes Titan, Tata Consumer Products, and Tata Motors, all in a single investment and often at a discount. It functions as a quasi-index fund for the Tata Holdings. Similarly, Bajaj Holdings serves as a proxy for India's growing financial services and automotive sectors through its stakes in Bajaj Finserv and Bajaj Auto. JSW Holdings offer exposure to the steel sector. This strategy appeals to investors seeking diversification within a conglomerate's holding, combined with a built-in safety margin of undervaluation. It's like investing in a discounted, closed-end fund focused on a specific conglomerate. While the primary goal here is less about the discount closing and more about comfortable diversification, if the theme plays out, the discount might also moderate, offering a bonus return. However, you should be careful. Not all holding companies are well diversified. Kama Holdings, for instance, is largely a single company play. Let's look at dividend yield plays. A few select holding companies offer acceptable dividend yields, which can attract income-focused investors who are looking for a return while waiting value appreciation. Let's take an example. Kama Holdings again. They distribute most of nearly all their earnings. Tata Investment Corporation. While they offer a modest yield of around 0.4%, it is consistent and likely to grow given its high payout ratio. Some investors might even treat these as a quasi-holding company preference shares, collecting dividends and hoping for a windfall if a restructuring happens. Now, this strategy involves targeting holding companies that pay decent dividends and whose underlying companies have stable dividend policies. Now, it's important to note that many holding companies such as Summit Securities, Kalani Investment, and Pilani Investment have negligible dividend yields and payout ratios, making this a selective strategy. Now, in summary, holding companies in India remain a fertile hunting ground for value investors. However, it's important to focus on those with good underlying business and high discounts, exercising patience and keeping an eye out for any catalysts. What do you think? Share your thoughts in the comments below.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges.